Hello, and welcome to the latest installment of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like New York to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, I am reviewing a recent report by Craig McCarthy and Chris Nesi, writing for the New York Post, entitled Mamdani Publishes Names and Addresses of All NYC Property Owners Who Could Be Hit with the New Pied-à-terre Tax. Now, the pied-à-terre tax, or the tax on high value second homes, is something we have covered in great breadth and depth on earlier episodes of Legal Bites. I will then conclude by explaining how small and medium-sized businesses can utilize the power of New York law to their advantage to relocate out of New York or out of another jurisdiction to a new state while keeping their existing federal employer identification number, contracts, bank accounts, and in most cases, their company name. But first, a brief introduction. My name is Chad Daniel Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 12 professional licenses and certifications spanning accounting, tax, audit, financial planning, and of course, the law. My firm website is www.cummings.law. The so-called pied-à-terre tax was sold to the public as a tax on an estimated 31,000 luxury second homes in New York City. Mayor Mamdani's administration published a searchable database of property owners potentially subject to the tax. The New York Post counted over 960,000, almost 1 million residences and individuals on that list. The tax that was supposed to target 31,000 homes has produced a database 30 times that size. The list includes the full names and addresses of every property owner. It covers condominiums and co-ops valued at $1 million or more, and 1, 2, 3 family homes valued at $5 million, where the owner has a separate primary residence. The problem is that the city's identification methodology has swept in properties and people who have no connection to the stated purpose of this tax. Modest homes in working class neighborhoods appear on the list. Dozens of addresses on Challenger Drive, for example, in middle class Staten Island, appear on the list. Council Minority Leader David Carr, whose own home appeared in the database, called the publication reckless and foolish, noting that thousands of properties on the list do not qualify as second homes and their owners will dispute the inclusion. Author Alex Berenson reported that his 81-year-old mother, who has lived full-time in her townhouse for 30 years, received a letter stating that she owed $56,000 under the new tax. Keep in mind, this is an elderly woman, not a billionaire with a vacation apartment. She lives in her own home. It is her primary residence, and they sent her a tax bill anyway. City Hall projects the tax will generate $500 million per year. Remember, this is a recurring tax. The city comptroller's office projects a lower figure of approximately 340 to 380 million, with collections expected to decline over time as property owners sell, dispute, or leave. And they are leaving, but I'm getting ahead of myself. The comptroller's projections acknowledge what the mayor's projection does not, that the tax base will shrink because the people subject to the tax will respond to it by leaving. The mayor announced the tax in April by filming a video outside the penthouse of Ken Griffin, a billionaire hedge fund manager, and naming him and the price he paid for the property. Griffin responded by stating that the video put him in harm's way, referencing the killing of United Healthcare CEO Brian Thompson in Manhattan in December 2014. 2 months later, the mayor's administration published this searchable database containing the names and addresses of almost 1 million property owners. Remember, this is a public database. It is searchable. It identifies by name and address the people who own property the city believes is worth enough to tax. This is the pattern. The tax is proposed as targeting only the wealthiest, and maybe at first it does. The threshold is set at a level that sounds reasonably high, but the implementation sweeps in 30 times, not 13, 30 times the number of people originally described. Working class neighborhoods appear on the list. An 81-year-old woman living in her own home receives a 5-figure tax bill, and the city publishes the names and addresses of everyone it believes it can reach. The California wealth tax, which we have covered at great length in earlier presentations, was also proposed as a one-time tax on billionaires. Within 6 days, Congressman Ro Khanna of California stated that in his view, the threshold must drop to 50 million. Within weeks, the co-author of that proposal admitted it should not be a one-time event, but instead should be a recurring tax. The New York pied-à-terre tax was proposed as affecting only 31,000 homes, and yet we have 1 million entries on the list. The scope always expands. The politicians are always greedy, and the threshold always drops while the list always grows. New York ranks in position number 50, that is dead last on the Tax Foundation's most recent state tax competitiveness index. The combined state and city income tax rate exceeds an eye-watering 14%. The pied-à-terre tax is only the latest addition. Federal Internal Revenue Service migration data show New York experienced the highest rate of population loss to other states, and the top destination, perhaps not surprisingly, was Florida. With this context in mind, redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering federal income tax repercussions, but only when performed with the strict formalities required by the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. When performed by a competent professional, and that is an important caveat, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts. That is to say, there is zero operational or financial disruption, but only if you get it right the first time. That is why it is so important to work with a credentialed professional and save the DIY for home improvement. I have successfully completed redomestications from all 50 states, yes, including New York, and for limited liability companies, partnerships, subchapter S corporations, and subchapter C corporations. So if someone is telling you it can't be done, what they are really telling you is they don't know how to do it. Now, foreign entity registration is also not the same thing as redomestication, because foreign entity registration, also referred to as foreign qualification, does not change the company's domicile. In fact, it does the opposite by keeping the entity in the former state indefinitely and merely adding another layer of compliance and tax obligations in the new state, leaving you anchored permanently to the state you were trying to leave. Meanwhile, a traditional merger, which is also not the same thing as redomestication, creates a new distinct entity in the destination state, may and often does require the issuance of a new federal employer identification number, and can trigger serious tax consequences. Finally, dissolution should not enter the conversation at all, because dissolution terminates the company. Dissolution is a going out of business maneuver, not a relocation mechanism. Dissolution is often a taxable event, and when performed incorrectly, can expose the owners of a company to unlimited personal, yes, I said personal, joint and several liability for the company's liabilities, known and unknown. That is because the so-called veil of liability protection no longer exists because the company no longer exists. So if you think dissolution is a cost-saving mechanism, you may be in for a rude awakening. And if you have a so-called professional suggesting dissolution as a relocation stratagem, please seek better advice. Redomestication, when paired with a change of personal residency and that is an important and, a reduction or outright cessation of operations in the former state can reduce or even eliminate state tax exposure there for the entity and its owners. Don't take my word for it, ask your CPA. Now is the time to consider acting before the legislature in Albany considers changes to the law in New York to hinder or even eliminate the option of redomestication. If you have questions regarding potentially redomesticating your existing LLC or corporation out of New York or out of another state, please use the link in the description for more information on this process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Daniel Cummings of the firm Cummings & Cummings Law, and I hope that you found this information informative, if not somewhat distressing. As always, the information in this presentation is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on these topics, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.